Let's dive right into this explainer and break down SiriusPoint's standout Q1 2026 financial results. We are looking at a seriously fascinating turnaround story today. It's a journey driven by strategic de-risking, improved profitability, and, ultimately, an upgraded A rating. If you follow specialty underwriting and capital management, the moves SiriusPoint has been making over the last year, they're practically a masterclass in disciplined execution. To get a clear picture of how they pulled this off, we'll hit 5 key areas. First, the Q1 2026 financial highlights. Then, the drivers of that profitability, how they're de-risking the portfolio, that crucial S&P ratings upgrade, and finally, how they are returning capital to shareholders. Section 1. Q1 2026 financial highlights. Right out of the gate, the company posted a very strong $100 million in net income available to common shareholders. Now, when a specialty underwriter hits a milestone like that in a single quarter, it immediately signals that their core operations are literally firing on all cylinders. But, raw income only tells part of the story, right? We've got to look at how efficiently that capital is actually being deployed. And that brings us to their capital efficiency, which is brilliantly illustrated by an annualized return on equity of 17.4%. That is a massive leap from the 12.9% we saw this time last year. Hitting an ROE over 17% means they aren't just making money, they're generating exceptional returns on the capital their shareholders have entrusted to them. As a specialty underwriter, SiriusPoint's execution in Q1 just screams discipline, both with capital and with risk. It is definitely worth noting that this strong net income wasn't just bolstered by increased underwriting income. They also had some smart strategic moves in there, like the gain on the sale of Arcadian Risk Capital. It really shows a management team that's actively optimizing their whole business structure. When you line up the year-over-year data, you can truly appreciate the sheer scale of their outperformance. Net income available to common shareholders jumped from $57.6 million last year to roughly $100 million this year. And they completely crushed consensus estimates, hitting 82 cents per diluted share compared to the expected 65 cents. That's a commanding 17-cent beat, which is exactly the kind of operational momentum you want to see. Moving on to Section 2, drivers of profitability. Their core combined ratio landed at 88.9%. Now, if you track insurance metrics, you already know that a combined ratio under 100% means the company is making an underwriting profit, and that's before even factoring in investment income. So coming in sub 90%, that is an excellent indicator of highly profitable, strictly disciplined underwriting. But what's really interesting here is the context. Improving this metric by 6.5 points year over year marks their lowest and therefore best combined ratio in 6 quarters. They basically shaved off a huge chunk of expenses and losses relative to their premiums. It completely validates their strategy of prioritizing margin over pure volume. Section 3. De-risking the portfolio. This is where we really see that intentional pivot play out. They achieved an 8% growth in their insurance and services gross written premium, while at the same time intentionally driving a 10% decrease in reinsurance premiums. They're not just scooping up any business that comes their way. They are deliberately shrinking the segments that introduce unwanted volatility and expanding the areas where they have a stronger, much more predictable edge. To do this, they aggressively targeted and cut natural catastrophe exposures. Since 2022, they've been slashing their 1 in 200-year probable maximum losses. How? Well, by reducing line sizes, using more reinsurance themselves, raising attachment points, and heavily reducing exposure to secondary perils like floods, storms, and wildfires. It's a textbook example of pruning the risky branches so you can strengthen the core tree. Section 4, S&P ratings upgrade. All of this disciplined risk selection didn't go unnoticed. S&P Global Ratings specifically highlighted SiriusPoint's consistent, robust earnings as a primary driver for their evaluation. S&P pointed out that this solid performance has allowed SiriusPoint to build up a significant excess of capital, sitting well above their 99.99% confidence level. And consequently, S&P upgraded their core insurance operating subsidiaries to a solid A rating. And by the way, Fitch and AM Best also upgraded them to A in the last 3 months. Guys, this is huge. Securing that A rating validates the entire de-risking strategy, gives clients way more confidence, and generally lowers their cost of capital moving forward. It's a real game changer. The mathematical foundation for this newfound strength is crystal clear. Common shareholders' equity, excluding accumulated other comprehensive income, which, remember, strips out those unrealized market fluctuations to show the true operational value, grew substantially. This perfectly showcases that significant buffer of excess capital S&P was talking about. The balance sheet is, quite simply, fortified. Section 5. Returning capital to shareholders. So what does this actually mean for investors? The tangible result is a 5% increase in book value per diluted common share excluding AOCI, hitting $18.98 by the end of Q1. Think about that. When a company shrinks its risky premiums but still manages to grow its book value by 5% in a single quarter, management is creating real measurable value. Furthermore, they returned a massive $242 million to shareholders in Q1 alone. They completely retired $200 million of expensive preference shares, which S&P expects will drop their financial leverage from 28% down to roughly 23%. And on top of that, they aggressively bought back $42 million in common stock and even upped their full-year share repurchase commitment to $174 million. As we wrap up this explainer, the strategic turnaround here is undeniable. SiriusPoint has shed volatility, printed a sub-90 combined ratio, earned their A rating, and bought back a mountain of shares. It leaves us with a genuinely fascinating question to watch over the coming quarters. With the balance sheet secured and risks heavily reduced, what is SiriusPoint's next major capital move going to be to drive growth? Definitely keep an eye on this one. Thanks for walking through this data with me, and as always, keep questioning the numbers.